In a surprising twist, Canada's economy showed more robust growth than anticipated in the second quarter of 2024. According to the latest data from Statistics Canada, the nation's gross domestic product, that is GDP, increased at an annualized rate of 2.1% during this period. This performance exceeded both economists' forecasts and the Bank of Canada's earlier predictions of 1.5% growth for the same quarter. However, beneath this seemingly positive figure lies a more complex economic reality. Despite the overall GDP growth, the picture is less rosy when you delve into the details. For the fifth consecutive quarter, GDP per capita fell, highlighting a troubling trend of declining individual economic well-being even as the economy expands. This decline underscores a persistent issue. While the economy grows, the benefits are not being equally shared among Canadians. The growth in the second quarter was largely driven by increased government spending and higher wages. Public sector spending rose significantly, fueled by retroactive wage increases for federal workers and increased hours worked by government employees. Business investment also saw a boost, particularly in machinery and transportation equipment. However, this growth came with notable drawbacks. Residential investment dropped by 1.9%, the largest decrease since early 2023, reflecting a slowdown in both new construction and renovations. Consumer behavior also shifted during this period. While households continued to spend, their spending growth slowed. Expenditures on essentials like rent, food, and utilities increased, but purchases of vehicles and travel spending declined. This cautious spending reflects broader economic uncertainty and diminished consumer confidence. Looking ahead, the economic momentum entering the third quarter appears weak. Monthly GDP growth was flat in June and preliminary estimates for July show no improvement. This sluggish start to the quarter raises concerns that the economy may not meet the Bank of Canada's previous forecast of 2.8% growth for Q3. Given this backdrop, there's growing speculation that the Bank of Canada will further reduce interest rates. The central bank is expected to cut its key interest rate by 25 basis points in its upcoming meeting on September 4, bringing the rate to 4.25%. Some analysts even suggest a 50 basis point cut could be on the table, depending on the economic conditions and market reactions. The implications of these rate cuts are significant. Lower interest rates could potentially stimulate economic activity by making borrowing cheaper and encouraging spending and investment. However, there are also risks. Persistent weak growth in consumer spending and residential investment, combined with a high inflation rate that remains just above target, means that the Bank of Canada must tread carefully to avoid igniting inflationary pressures while trying to support economic growth. So, while Canada's second quarter economic performance was better than expected, it is clear that underlying challenges remain. The anticipated interest rate cuts by the Bank of Canada reflect a balancing act between fostering economic growth and managing inflation. As the central bank prepares for its September meeting, all eyes will be on how it navigates these complex economic signals. **Canada's Economics. Stay subscribed for more videos.